Hello and welcome to Business Talk, brought to you by the Sharonville Chamber of Commerce. I'm your host, Britt Scarce with Emory Federal Credit Union. And today, here in studio, we have Steve Goldman, owner of Paulin Goldman, to talk to us about the tax law changes for 2018. Steve, welcome to the show.
Thank you, Britt. It's good to be here.
So, we've heard all this bluster. We've heard all this stuff on the news that, the tax laws changed, and some people are saying it's awesome, I'm going to, pay less, and other people are saying, no, it's not that great. So you help us, can you help us cut through the noise today?
Sure. I get asked that question a lot, and as I tell my clients, I do believe at this point in time, everyone or most everyone will pay less in taxes. I think for the most part, as we talked about, the tax rates have gone down about 3% for most people. The other big thing for families is the child tax credit has gone from $1,000 per child under age 17 to $2,000 per child under age 17. So that's going to be a big savings. And then the income at which that credit phases out has been greatly increased. Used to be before, if your income was over $110,000, you might not get that credit. Now they've increased that 110. I think it could be somewhere like around 300,000.
Oh wow!
So now
a lot more
people are going to get the $2,000 credit.
How about the standard deduction? Did that change?
Right. The standard deduction is now $24,000 for married filing joint, but there's no more personal exemptions. So it's sort of a give and take, a wash. If you had a lot of kids, you might lose out. If you don't have a lot of itemized deductions, you might win out with the $24,000. But one thing I did for today's show is I just ran a quick example of 2017 versus 2018. And this is an example for married filing joint with 2 kids and joint income of $120,000. And this is all on a W-2.
Okay.
In 2017, your federal income tax would be about $11,400.
Okay.
And for 2018, your tax liability would be about $9,300. So it's a decrease of about $2,000 for a married filing joint. And one more interesting thing, and I think we'll talk about it a little bit more when we talk about the tax laws as they affect businesses, but there's an extra deduction for if you own your own business. And in the same example I just did, I'm going to do it as $120,000 of income, but if $60,000 of that is from self-employment and $60,000 of it is from a W-2. If you're self-employed, that $9,300 goes down to $7,200.
Wow.
So if you're self-employed, there's some extra deductions for you, which we'll talk about. So I think everyone's going to pay less in taxes. There's a lot more changes that are going into effect that we're still trying to read up on, but I think those are the big ones for families, is the lower tax rate and then the child care credit. So wow. I think it's good.
That's good news, because again, there's a lot of politics around this, and a lot of people that didn't want the tax cut say it's all bad, and then the other people that, that wanted it say it's great. So, I'm glad you're cutting through all the noise for us.
I guess it depends on which side of the aisle you're on. The top marginal rates are down too, so some people think that the wealthy, are also getting that 3% reduction, and so it just depends on what side of your aisle. But I think it's good for everybody. Mm-hmm.
Well, $2,000. I mean, to the average family. I mean, that helps pay for vacation. I mean, that helps with some people are paying for school tuition and things like that.
Absolutely.
That goes a long way.
Absolutely. I think would help out a lot of families. So that I think is the major things that are going on for the individuals, and there's a lot going on business-wise too.
Yeah, let's talk about the companies and businesses. What kind of cool changes
happen there
in store for them?
Sure. I think the big thing that people were looking at, and maybe a contentious issue, is they lowered the corporate tax rate for the big guys, the C corps, from a high rate of 35 down to 21%. So there's a big hubbub about all that, and whether you think that's right or not, to have a big tax cut for the big corporations. But in return for small businesses, because they gave the big businesses this tax rate deduction, if you're the owner of a small business, a pass-through entity, an S corp, a partnership, a sole proprietor, you get a deduction for 20% of your business income. Okay.
Okay.
And I do have to say, as with all tax laws, it's a little bit complicated. It's not as easy as my income is $100,000, 20% of that is 20 grand, I get a deduction for 20 grand. There's more complicated issues to it. For one, it phases out. When your income for married filing joint is in excess of about $315,000, it starts to phase out. If you're what they call a qualified service provider, the deduction gets phased out too. If you're in law, accounting, I don't think it's engineering. So some of those service businesses, like doctors, they're not going to give you this 20% deduction, and that's where it starts to get complicated. Who's eligible for it, who's not, how it's defined. But that's really
That's
the big
why
thing.
it's really good to have an accountant. Right?
Well, I tried because, the thing is, and as you can see in that deduction example I gave earlier, when half of your income was business, half of it was W-2, you save $2,000 more than if it's all on a W-2. So, there's a lot going on. Why did they give the deduction to small businesses but not people that are working on W-2? Well, it's, I guess, politics. I don't know how they figure that all out.
They figure that they're trying to reward the folks that maybe are creating jobs and trying to incentivize them to maybe hire more people.
Yeah, but you know what happens, because I guess I'm in the tax industry, it just creates game playing.
Okay, they just move it from
right. We were talking about
plays.
Right now, everyone's going to want to be an independent contractor instead of on a W-2, and so now you start playing these games. You got the lower tax rates on the C corps at 21%. So now maybe you shift income over there, and you just start all this game playing again. And it's it's good for my business. It's good for the attorneys, and we talked about it earlier. The cost of compliance is really a shame. My thoughts on that subject is I think a typical small business, a garden store down the street, maybe a cleaning service, between having to pay for payroll services and tax services and accounting services, and we talked about it, they could pay $3,000 or $4,000 a year. Well, we talked about that with the $2,000. $4,000 a year is someone's mortgage payment for 2, 3, 4 months or whatever, and it's just. I hate to say it because I'm in the business, but it's just a shame that all these small businesses, and then not only is it the money, but how much time do they spend on it?
Yeah, that they're not, spending working on their business and increasing sales.
And then the worst thing in the world too is if they're not somewhat aware of their tax situation, it comes down to the end of the year, and the accountant hands them their taxes and say, oh, by the way, you owe 30 grand in taxes, right? And they don't, you surprised, we were just talking about that, and you've worked hard the whole year, and you thought you had a really good year, and you maybe put 10 grand in your retirement plan and took a 10 grand vacation. Now you're 30 grand short on your taxes, and I don't know. It just I've seen it happen so often that it just gets upsetting a little bit with all that. But anyways, that's sort of not off the subject. I think one other there's quite a few provisions for businesses, but one of the other things that I think is important for small businesses to know that's changed, and it's in a negative way for them, is a lot of businesses, the first year of operation, they have a net operating loss. And a lot of those businesses count on carrying back that net operating loss to prior tax years and getting a refund back. And that happens quite often. Well, the new tax laws cuts out that net operating loss carryback.
Okay.
So it's going to hamper some businesses. And then you now, and in the past, you could always carry them forward to offset future income, but now they've sort of limited that too. They've limited the amount, the net operating loss write-off per year is limited to, I think, $500,000, and then you can only write off up to 80% of your income. So if you have a $500,000 loss this year and $500,000 income next year, under the old laws, you wouldn't have to pay any tax. But now you can only write off up to 80% of that, so when you make the $500,000, you now have to pay tax on it. That extra $100,000 you don't use, you can still carry forward indefinitely. So it's a timing difference, but it's still is an issue, because like I said, a lot of businesses obviously lose money in their first year.
Yeah,
And then,
it's usually expensive to start up
right.
a business.
And then they get, they come in from a business where they had high income, maybe they're on a W-2 executive at a bank, making a lot of money, and go to owning their own business and have a loss. They carry it back to that year and get back a nice refund, and it helps them out. So that's one thing that's negative in the tax laws. But I think the only other note I have really for small businesses is some of the depreciation rules have changed, and they basically have become more generous.
Oh, wow.
Yeah, so you're able to write off, they have what they call bonus depreciation, which is 100% of the asset purchased. And then they also have what's called a Section 179 deduction, which allows you to write off up to $500,000 of equipment. So
is that going to encourage more businesses to maybe, go ahead and buy new equipment
I
now
think so.
rather than
Yeah,
later?
I think so. I know, some of the commercial lenders and bankers that I work with, come December, they remind their clients that, Section 179 allows you to write it off. And I have a few clients that do that. A client needs a new dump truck, and it's $200,000. You go out and borrow the money, so you're only out of pocket, $5 or $10 grand down payment, but you can still expense off that $200,000. That could take care of your tax liability for a year. Once again, it's just a timing difference, but at least for this year, it's gotten your tax liability down by quite a bit. So,
So what do you think folks should do right now? I mean, we're in July. What kind of actions should they take right now to kind of figure out where they're at? And
I think we were talking about it earlier also, and I guess I have to say it because I'm in the business, but especially if you have your own business, you really do need to get with your accountant and do a projection. If you're self-employed, you should be making estimated tax payments. Your third estimated tax payment is due September 15th. So I tell all my clients that first, second week in September is a good time to call me. It's not my busy season. You've got 9 months behind you. You sort of know where you're at. You know where you can project where you're going, and we can take a look at things for you. With all these changes, I just think it's important. Do they need to buy capital assets? A lot of times I get questions on retirement plans. Those are big ones. Should I put in now, later? How much should I put in? You get asked the question, should it be a Roth? Should it be a traditional? Pension plans come in all sizes and shapes, from IRAs up to 401ks, up to profit sharing plans. You can put away a lot of money if you want to. Some of those plans have to be set up before the end of the year. That's where the tax laws get so crazy. An IRA, you can contribute up until April 15th. Simple plans and 401ks, you got to have them set up before the end of the year. And as you know, there's pension experts. That's all they do, because that area has gotten so complicated. So I think it's just a matter of getting together and talking with your accountant. Obviously, everyone's different. With it, but there's still a lot out there as far as write-offs and tax planning, and now you got to look at the C corps and the S corps and all those other things. So it shouldn't really take long. I mean, if you've been my client for a while, I know you. 15 or 20-minute conversation, should get the job done as far as what's
this
new.
is where you're at so far this year. Hey, I plug these numbers in. This is about what it's looking like. And hey, if you do this, you might be able to save a little more.
Right.
Give yourself. We're in July, so there's time to do some of this.
Exactly.
So but overall, you feel that the new tax laws are going to be a kind of a net win for most people.
Yeah, I do believe that, and like we were saying earlier, it's still, the tax laws are new. So they're still interpreting them. What's sort of crazy is, the IRS or Congress writes the tax laws, and a lot of times, we talked about it, at the end of their paragraphs, they'll say, or as interpreted by the IRS. So then the IRS has to issue rules and regulations trying to figure out what Congress meant, and it's a moving target. I don't know how many regulations the IRS will issue over the course of a year, but there are a lot of them, and there's private letter rulings and people, and so it's just constantly changing, and it's just very difficult to keep up with. We talked about just how much time it takes, and how much you have to read and how much you have to study. And it's like in any business, it's an art to be able to do research and get the answer. I mean, I was looking something up today. A client asked me a question, and I mean, I hate to say this, but I couldn't find the answer. You know, I spent a half hour on it, and I couldn't find the answer. So now I got to go back and spend more time on it.
Yeah.
It's just one question from one client that I'm going to spend an hour on trying to get the right answer.
Because it's not clear cut in the law.
Right, and the craziest thing too is, and I learned this a long time ago, is you know, thank goodness for the internet where you can do research. But when I Google something and I pull up an article, the first thing I look at is the date on the article.
Yeah.
Because if it's more than 4, 5, 6 months old,
yeah,
I won't read it.
Maybe even more than a week.
Yeah, maybe even yesterday, and it just gets so frustrating to. You know, you're sitting there, you read this article, and then at the end, you know, it says, you know, 2015. It's like, oh, God.
Yeah, that's totally changed now.
Well, and the thing is, you read these, you read through this stuff, and then you come to the end of the article, it's like, what was that? You know, what did I read?
Yeah.
You got to go back and read it again. You got to read it 3 times. And then a lot of times, you got to go to a seminar and have someone explain it to you because you still can't understand it after you sat there and read it. And I think that's why it's important. You know, I've got a partner, and you have someone to bounce ideas off of and get other input, just like in any business. But
and you got that hotline right to the IRS too, don't you?
Have you tried calling the IRS?
Yeah.
In seriousness, they're overworked, they're understaffed, they have a huge problem with identity theft.
Yeah.
So a lot of their resources are going to combat identity theft. When I send a letter to the IRS in response to their requesting some information, about 5 weeks after I send that letter in, I get a letter from them. And the letter says, we received your response. We need 2 more months to respond.
Wow.
Yeah. So it takes them 4, 5, 6 months to respond to a letter. And in the meantime, your client's nervous because they're getting letters from the IRS. And so it's just very difficult, you know, in dealing with the IRS, which like we said, it's not good for anybody to have to go through all that. So,
well, I think that's all the more reason to have a professional help you decipher all of this. And it's really encouraging to see that you've crunched the numbers on a lot of different situations and found that for the most part, most of us are going to see some sort of a break this year.
It is, and I know it sounds sort of crazy, but this is sort of what I love to do. And if you ask my wife, it's about the only thing I can do, you know. So, but I shaking her head over there. It's the truth, you know that, hon. But no, it's just for some reason I've just always enjoyed doing this. It's a challenge. You can always learn something new. And, you know, it's people-oriented. You know, I have a lot of clients that I've had for a long time, and you get to know them. And it's fun. You get to, it's almost like you're their analyst, because you know if their kids are going to college. You know if their kids have dropped out of college.
You know what's coming up for
my
them.
kid's getting divorced. Are there any tax consequences? You know, my kid's in jail. You know, is bail money deductible?
Gosh,
you know, all these things. And, you know, you grow up with them. So it's just a really neat business to be in, and I'm very fortunate to be in that. And I've got a great staff of people with me that work very hard and you know, help make me look good. So
that's great.
So it's been fun. It's been fun.
Well, Steve, thank you so much for coming in and going through all these new changes with us. It's great information.
Well, thank you for having me. As you can tell, I can talk all day on this stuff, and I'm going to test you on it at the end and see if you can remember what the tax brackets are. But thank you for having me. I appreciate it.
Thank you, Steve.
Thanks, Britt.
Our guest has been Steve Goldman, and hey, this is stuff that is absolutely going to affect everybody. So hopefully when you do your taxes in 2018, like Steve said, you'll end up with a nice little savings from previous years. You've been watching Business Talk, brought to you by the Sharonville Chamber of Commerce. I'm Britt Scarce with Emory Federal Credit Union. Till next time.